Welcome, everyone. I'm Carlos Martín, Director of the Remodeling Futures Program at the Joint Center for Housing Studies, and it gives me great pleasure to welcome you all to today's lecture, which is part of an ongoing series of events that we do at the Joint Center for Housing Studies that you can find on our website at jchs.harvard.edu. And while we're talking about all the series of events, I do want to call attention in particular to two upcoming events. On Thursday, April 3rd at 6:30 p.m., Peter Barber, a British architect known for his unique approach to social housing and urban planning, will be speaking on reimagining social housing. This will be in person at the Graduate School of Design at Harvard, but will be also streamed online. So we invite you to register for that. Second event is on April 18th from 1 to 5 p.m., where the Joint Center is hosting a half-day symposium on the evolving landscape of social housing in New England. This also will be in person at the Graduate School of Design, but I'm happy to also say it will be streamed online. So more details, including the registration links for these and other upcoming events, are on our website. We invite you to join those, register, and sign up for future notifications of events. Now on to today's topic. So I should note that not just today's topic, but today's speaker. About a year ago, the Joint Center for Housing Studies, including myself, were actively searching for newly minted PhDs to join the center to be our first ever postdoctoral fellow focused on climate and housing. We had many other postdocs in the past, but our search this time around had to be wider in terms of disciplinary coverage, but also more narrow in terms of understanding the rapidly evolving policy and practical space of climate and housing beyond what may be considered the traditional academic mastery of literature. We had an amazing group of candidates, but we were very lucky to land Dr. Stephen Koller, who is now wrapping up his first year as the postdoctoral fellow in climate and housing. Dr. Koller's research primarily focuses on urban flood risk, climate risk exposed insurance markets, federal hazard mitigation and disaster programs, as well as decarbonization in the buildings and transportation sectors. But his work aims to inform policy design, especially towards inclusive climate resilient development. So it is no surprise that a bulk of his recent work, including his dissertation, focused on home and hazard insurance, arguably the most rapidly evolving piece of the housing institutional framework, and what many activists and scholars would refer to as the first financial signal of climate change's effects on housing markets. To say that home insurance has been a major media story is an understatement. The story has been playing out, but the story has been playing out for much longer. I would like to remind folks that going back to the Great Chicago Fire of 1871, private insurers, mainly of institutions and larger commercial properties, threatened to refuse further coverage, and in some cases, insurance policies altogether for properties, unless the city of Chicago centralized a non-voluntary fire department and buildings department with the authority to enforce strict fire codes. As many of you know, who may be watching, I am prone to wax historic about this evolution in insurance and housing, but I only know two other relevant moments, so please indulge me, over the last decade that are relevant to today's conversation. And that started out with the Great Mississippi River flood in 1927 that displaced so many people, damages from which led private insurers to conclude that insurance against the peril of flood cannot be written, cannot successfully be written, unquote, which eventually led to the National Flood Insurance Program that Stephen is going to be speaking about today. And just last month, Federal Reserve Chairman Jerome Powell warned in a hearing with the Senate Banking Committee, and he said it almost in passing, that both banks and insurance companies are pulling out of coastal areas or areas where there are a lot of fires. And what that is going to mean is that you fast forward 10 to 15 years, and there are going to be regions of the country where you can't get a mortgage. The press immediately labeled these mortgage deserts. So property losses and insurance claims are expected to exceed $250 billion from this year's fires alone. So there are questions swirling about who is going to pay for these losses and whether it is through rising insurance premiums for everybody, public bailouts of most likely at the state level, given recent rhetoric around the National Disaster Management Framework and its changes, or homeowners and communities themselves simply absorbing these significant losses. And that burden would certainly be unbearable to low-income households. So enough about my blathering about history and about where we're finding ourselves. Enter Steve Koller. Steve previously worked as an economics and policy analyst at the Environmental Defense Fund and as a summer associate at RAND. He earned his bachelor's and two bachelor's, a BS and a BA from Penn State, master's from UC San Diego's School of Global Policy and Strategy, and as we noted a year ago, a PhD in environmental science and policy from the University of Miami's Rosenstiel School of Marine, Atmospheric, and Earth Science. Before I pass the mic to Dr. Koller, I would like to remind everybody who's listening to use the Q&A function if you want to ask questions. You see it below you. Feel free to start asking questions during the event. We will not be answering until after the presentation, and we'll try to get to as many questions as we can after Steve is finished. And I will take the host prerogative of asking a few of my own questions while we're reviewing some of the questions that have come in. The second reminder is that Steve's talk will be recorded and the slides will be posted on our website by early next week. So with that note, I will sign off and I invite Dr. Koller to join us in video and to prepare his slides.
Wow, thank you so much for that introduction, Carlos. And I really appreciate your waxing historic, because I think we'll have a nice bookend towards the end of the presentation. So as we mentioned, the title of today's talk is Public and Private Residential Insurance in a Changing Climate. And it's probably safe to assume that most folks attending this webinar, like Carlos alluded to, have seen a good number of news articles focused on natural disasters. And in this coverage, you've probably heard references to residential insurance and links to climate change. Today, we're going to delve into some of this complexity and use some recent data to guide us. Residential insurance can seem like a mundane topic, and it really can be, but it's also a crucial element of our housing finance system in the US. And one of the reasons we're seeing so much attention on this issue is that residential insurance is widely purchased, and it's where many people are really starting to connect the dots between the impacts of climate change and their own pocketbooks. So just to give a general roadmap of what we'll discuss today, first we'll do some definitions and an overview of public and private residential property insurance. The goal is to have a better understanding walking away from today of the role of residential property insurance in the housing system, particularly as it relates to households, and how climate change impacts are intersecting with existing markets and regulatory environments. We'll also highlight how climate-related perils are starting to stress some private residential property insurance markets in parts of the country and what that implies for wider public financial risk. We're going to rely on some really interesting new homeowners insurance data made public in recent months by the US Senate Budget Committee, as well as the US Treasury Department. And then we'll leverage some California Fair Plan data and satellite imagery to look at the Eaton and Palisades fire affected areas specifically, and some recent homeowner insurance trends we saw leading up to those fires. Last, we'll have a look at federal and state policy outlooks. Of course, we live in a moment of really profound and rapid political and policy change. So what are some top issues to be keeping an eye on amid these changes? If you walk away from this presentation not having anything stick, aside from these 4 points on this slide, then we'll consider that a pretty good outcome. First key point we'd like to get across is that rising residential insurance costs are adding to already high housing cost burdens. This is happening for both property owners as well as renters. These cost rises are not impacting the country uniformly or evenly, and we're seeing more acute cost increases in areas with high relative climate-related peril risk. I would also point folks to a recent research brief from colleagues here at the Joint Center on the costs of homeownership, and insurance is, of course, a part of that story. Next, I hope folks will walk away understanding that the availability of insurance, as well as the affordability of insurance, are distinct but related challenges. If someone is thinking about moving into a new home, they may be wondering, will private insurance be available in my area in 2, 5, 10, 20 years? And if I can still get a policy, how much will it cost? Third, important to note that there are multiple chefs in the kitchen who are trying to cook up sustainable, affordable private residential insurance. There are property owners, there are community and regional level land use managers. In the private sector, we have folks who are developing innovative financial products as well as construction materials and methods that can reduce financial and physical vulnerability to climate-related perils. And then, of course, regulators are doing their best to ensure that their constituents have available and affordable residential insurance. I'll note here, too, that it's not just home hardening measures that we can take at the property and community level, but reducing greenhouse gas emissions across the economy is an upstream way that we can reduce the impacts downstream from these climate-related perils, which we'll talk more about later in the presentation. And then last, I know we're going to say the word insurance a million times today, and of course, that's the focus here, but insurance is not a panacea, and it's just one tool in our risk management toolbox. Risk-based pricing, which insurance often is, isn't always, but often is, can really effectively signal where risk is, but it's not designed to directly reduce risk. So we're going to have a multi-pronged approach as we aim for sustainable, decent, and affordable housing across the US. So overview. Sorry, it's moving forward a little bit here. What is residential property insurance to level set? Well, our definition here today is it's a type of property insurance that covers a policyholder's residence and or the contents of their residence. And the type of perils that are covered within a residential property insurance policy will depend on the specifics of your coverage and what you've purchased from your insurer. So here are some examples of common residential insurance policies. This is not an exhaustive list. We don't have time for that today, but this is a general overview of types of policies, whether they're multi-peril, covering against multiple perils being causes of damage, and or single peril, and what are they covering against? So homeowners insurance, this is the largest market share of the residential property insurance market by collected premiums in the US. The HO3 is the most common type of policy. This will cover is typically an owner occupier in this bin. It'll cover their structure that they live in, as well as the contents of their structure against multiple perils, which include wind, fire, vandalism, etc. Some of these perils are climate related, some are not. Then there are other options available to you if perhaps you're a landlord and you want to cover your structure but not the contents against multiple perils, that's available. If you're a renter and you want to cover your contents in your residence against multiple perils but not the structure, that's also available too. Then the last two in these bullets you'll see are single peril policies. These pertain to areas that are not typically written by regular multi-peril policies, standard policies. Flood insurance is one. The National Flood Insurance Program, as Carlos mentioned, is the dominant provider of residential flood insurance in the country, really focused on this specific hazard. And you can purchase this if you're in an eligible community for your structure or the contents of your structure. Earthquake, similar, single peril, can cover multiple asset types. And then why does residential property insurance matter? Well, we talked about this a little bit already, but I look at residential property insurance as a bit like a glue that helps the housing finance system stick together. Most home buyers are not buying in cash, so a homeowner's insurance policy, for example, can help a prospective owner get their foot in the door through access to mortgage credit, for example. Lenders will require this type of insurance before lending, either for a mortgage or a home equity line of credit. And if you're a renter, your landlord might require renter's insurance before signing the lease. Also, for most households in the US, the primary residence is one of or the most valuable household asset. And so by having residential property insurance, you're essentially preserving your hard-earned home equity. And there is research cited here that shows that in the wake of a disaster, people really do rely on insurance as their first line of financial defense to recover. And then last bullet here is that if you don't have residential property insurance, that can be a real financial vulnerability. And we see folks having worse outcomes in the wake of a disaster if they are uninsured. This estimate is from two partners within the industry, and they have a survey that found 12% of homeowners roughly in the US do not purchase homeowners insurance. So these are folks who are probably owning their home outright, not subject to lender requirements, and they have chosen to forego coverage for whatever reason. This number has ticked up over the years, so it's something to keep an eye on because that protection gap can really impact welfare. Now, I alluded to some chefs in the kitchen before, and now we'll start to get a better understanding of how insurance premiums are determined. Of course, this is a very complex process. We've tried to boil it down into 4 groups of parties. First are regulators. Now, since 1945, the McCarran-Ferguson Act went into effect. That's a federal law. And since then, the states in the US have generally been in charge of regulating insurance. So we have this constellation of diverse regulatory environments across the states and territories. And insurance companies will generally, or most frequently, have to comply with state laws and regulations to make sure that they're writing policies that are fair and not unduly discriminatory. So regulators play a role. Second, insurance firms play a role. I'm sure most of us on the call at some point have shopped around for different types of insurance policies, and maybe you call one insurance company and get a quote that's much higher than another insurance company for the same exact product. And so we see differences within the industry in the same geographies between pricing sophistication and business strategy. Also, we're not going to go down the rabbit hole of reinsurance too much during this conversation, but the behavior of the reinsurance industry does filter down into the insurance firms that we're typically dealing with as households. Third, as a policyholder, you also have some influence. Your individual home mitigations can impact your residential premium, insurance premium. For example, if you harden your roof or get a new roof, if you elevate your home above a certain level to mitigate against flooding, this can translate into potentially direct discounts in your premium. Additionally, your choice of deductible can impact how much you're paying in your premium. And then last, this is a bit of a catch-all, but external factors. So general community level physical risk, climate change would probably go into this category. Also, external economic shocks. So we've seen this inflationary period over the past few years, which has led to elevated costs for construction materials, labor, and replacement costs are a key factor in rate making. So according to some recent industry reports, recent spikes in homeowners insurance premium we're seeing are substantially driven by elevated replacement costs, and we're also seeing increasing event severity. And we'll talk about this more in a minute. To give a sense of where the market is at now, here we've got on the right side an axis showing the Case-Shiller National Home Price Index adjusted for inflation. That corresponds to the blue line that we're seeing. And over the past 10 years or so, we can see that the home price index is up 50%. So housing more expensive. This is, I'm sure, a surprise to nobody on the call. Then on the left side, we're looking at the average annual homeowners insurance premium paid. Those are the orange bars. And similarly, we can see in recent years a march upward in the number of, in the average annual premium paid, even adjusting for inflation. Now, if there are economists on the call, I'm sure you're thinking, what about income? Well, according to the Insurance Research Council, which is an industry group, even accounting for income, folks are paying more today for insurance than they did 10 years ago. And this is backed up by their data showing the percentage of income paid towards homeowners insurance. So this is an issue that is stressing many homeowners' budgets. Now on this slide, what we're trying to do is connect some of these really complex and science-based climate change physical impacts to our insurance policies. And so in this first column, we're looking at examples of physical impacts of climate change, and we've got the citation to the IPCC's latest assessment report here for those who are interested in more detail there. Then in the second column, we've got a list of perils, and peril is usually the term used in the insurance industry that corresponds to a specific policy. And then in the third column here, we've got examples of policies that typically cover the perils in the second column. So first row here, we're looking at impacts, sea level rise, and more extreme precipitation. These are impacts that we see emerge within a flood hazard context, flood peril, and the type of insurance policy you would purchase covering against flood is flood insurance. So there's one connection. Second row, drought, higher temperatures. We're, depending on your estimate, about 1.3 degrees Celsius today in terms of global mean temperature above pre-industrial levels. So warmer today than it was in pre-industrial times. This can impact wildfire. For example, we have here in citations as well a rapid attribution study from Barnes et al. That highlights the fact that our elevated global temperatures are, or in the wake of the Palisades and Eaton fires in Southern California, which we'll talk about, those fires became more likely and more intense as a result of these elevated temperatures. So there's a direct connection to this example we'll talk about. And insurance policies that are typically covering wildfire are homeowners insurance, renters insurance. So there's that connection. And then in the last row, physical impacts include more rapid hurricane intensification, as well as higher peak wind speeds. So these are generally related to wind peril. as well as storm surge, since storm surge is a function of wind, and the insurance policies which we might see these impacts emerge: homeowners insurance, flood insurance. So hopefully this gives you a little bit more intuition about the connection between climate change impacts and insurance policies. Here, we're looking at some homeowners insurance loss data specifically. And what I want to drive home here is that frequency of events matter, as well as severity of events matter. Generally, well, to take an example, wind and hail here on the left in the pie chart represented about 41% of total insured losses in 2022. Then we can see on the right in the table that wind and hail tend to actually have lower average claims than, say, fire and lightning. But wind and hail has a higher claims frequency, so it's a more frequent type of event and claim. So that's why it still makes up a large share of the pie. In the first row, we see fire and lightning, which tend to have a much higher average claim, over $80,000, but they're much less frequent than, say, wind and hail, which is why they make up a smaller share of the pie there on the left. Going forward, it'll be important to watch both the frequency and the severity of events. As I mentioned, the severity is generally what's been driving up loss trends in recent years. Now, this here is a real crux slide, I'll say. So I hope folks can stay with me here, and I look forward to the discussion afterwards about some of these nuances. But generally, what we want to do here is get across that there is variation in the scope and nature of public sector involvement in residential insurance markets across the country. And this variation cuts across both perils as well as political jurisdictions. So we've got this spectrum here from private to public, and we'll move from the right to the left here. We'll begin with a general grouping of admitted private insurers. So we start on the private side, some familiar faces here: State Farm, Allstate, some of the largest homeowners insurance underwriters in the country. What does it mean to be admitted? Well, this means you've met certain state licensing and regulatory requirements. And by doing this, there are at least two benefits. First, it signals credibility to potential policyholders that you've met these requirements with the state in which you're writing policies. And second, you can access state guarantee association funds in the event of an insolvency. And so this is gives peace of mind to policyholders. Important to note, admitted private insurers generally make up the lion's share of residential property insurance underwriting in the country. We're going to focus less on the non-admitted insurers and the surplus lines today, but these are also private insurers making up a relatively or quite small part of the market. They're a bit riskier on average because they don't meet the same licensing and regulatory requirements as the admitted insurers. They can't access generally the guarantee association funds. So if you're a policyholder with a non-admitted insurer and the non-admitted insurer goes insolvent, then you might have a higher risk of not actually getting any claim payout. That said, the risk in this area is a bit of a double-edged sword because there's some interesting innovation that's able to take place in that segment of the market. Now, moving left, we'll get into residual markets. And again, this is pretty simplified, but we're trying to give some intuition for the lay of the land here. Residual markets also may be insurers of last resort. That's a term you possibly heard. These plans are, again, generally established by states, given that regulatory configuration that we talked about with the federal law in 1945. And these plans are established to ensure that residential property insurance is available in states, even in high-risk areas where private insurers are not offering coverage. So about 2/3 of US states have a residual market, and the configuration of each is pretty different. Each one is a snowflake. And we have two general groupings here for simplicity. The first, right here, we call the state-mandated associations. The California Fair Plan is one example. I'm in Massachusetts now, so of course had to include that one, but there are more like it. I'll use the California Fair Plan's language to describe it because it's so specific. They say the Fair Plan is not a state agency, nor is it a public entity. There is no public or taxpayer funding. The Fair Plan is a syndicated fire insurance pool comprised of all insurers licensed to conduct property casualty business in California. So not public entities in this column, but publicly mandated through state law. And these are sometimes called the involuntary market because admitted insurers are required to participate in those in order to write policies in the state. Next, within the residual market, I include a second row that I think is worthy of distinction because these are actually government entities that are established, not just associations of insurers within the state. The most prominent of these is Citizens Property Insurance Corporation in the state of Florida. This is the largest residual market by number of policies in the state. And while they do not explicitly collect taxpayer funding, they do have some favorable tax exemptions. And I've included these examples here in the residual markets because they're generally along with the state mandated associations trying to move their residual market policyholders back into the admitted private insurance market. So across states, even though there's variation, there's the common goal of moving policyholders out of the residual markets into the private market. And then the last line here is fully public insurers. And the examples I use are FEMA's National Flood Insurance Program, the rationale for which we discussed earlier at the top of the call. But here in the case of FEMA, as well as the California Earthquake Authority, these are explicitly public financial entities doing the underwriting, established because of mass retreat of the private insurance industry from these specific markets. And you can see that they're both related to a specific peril, flood, earthquake. These, to my knowledge, do not generally have depopulation programs because the private markets are so tepid. FEMA writes most of the residential insurance coverage for flood in the country, and the California Earthquake Authority has most of the market share in California. And in the event of an insolvency here, for example, for FEMA, the alternatives are to raise the debt ceiling, so take on more debt, or as Congress has done in the past, cancel the debt outright. And then that is effectively cost that is taken on by the US taxpayer. All right, now shifting to how climate-related perils are stressing insurance markets. To get a sense of how markets are being stressed, first let's look at where we're at. And specifically, we'll start by looking at the homeowners insurance line of business. This horizontal line that we're looking at, the dotted one, generally represents the threshold for profitability. And the vertical bars are showing the annual amounts that industry paid for homeowners insurance each year. So bars that stretch above this horizontal dashed line indicate that insurers paid out in more in homeowners underwriting than they took in. So those are not profitable years. And as you can see, there are quite a few years in which this is the case. And when you hear about insurer retreat and availability issues, it's important to keep this in mind, that the homeowners insurance line of business delivers limited, uncertain profits, and it's not really a slam dunk for firms. Now we're going to start getting into some of the data that I mentioned earlier, primarily coming from the US Treasury Department's Federal Insurance Office. These data look at climate-related peril risks in the homeowners insurance market. Also worth noting that this work by the Treasury Department was in response to a Biden administration executive order on climate-related financial risks affecting the nation. So the data for this are currently publicly available, and we have the citation to the report at the bottom of the screen here. The report really has a treasure trove of data, hundreds of millions of data points that they're drawing from on homeowners policies, and Treasury groups policies into zip code quintiles, so 5 equal size groups, based on the expected losses to buildings in the zip code that are connected to climate-related perils, typically covered by standard homeowners insurance policies. We'll generally look at some indicators of market health and stress and compare averages across these quintile groups, the highest risk and lowest risk zip codes. On this slide, we're looking at differences in claim frequency, non-renewal rate, and non-payment cancellation rate across these groupings. We can see the higher risk zip codes tend to have higher claim frequencies, so they file claims more often. They have higher non-renewal rates. This means that insurers in those jurisdictions tend to choose to not renew a policy due to property level or community level risk factors. And they also, the highest risk zip codes also have relatively high non-payment cancellation rates. So this is pertaining to cancellations that are due to the homeowner not making a payment on their premium. When we're comparing these zip code groupings as well, we see that claim severity tends to be higher. So earlier we looked at frequency being higher. Also, severity is higher among this group at about $24,000 per claim between 2018 and 2022. And policies in the highest risk zip codes have significantly higher average premiums per policy. Now, we've made this connection between climate-related peril risk and relatively higher non-renewal rates, more frequent and severe claims, higher premiums. We're going to now examine these issues in the context of the residual market, which we've spoken about. This plot here shows just a general trend in recent years, especially in key markets, of an increasing number of residential policies moving into residual markets. Now, this plot does not show every residual market in the country, but we're just looking at some of the largest ones. The red bar, the bars, the lines pertain to state residual market plans, and the left axis, the number of policies in those plans. And then the green bars correspond to the right axis. We can see Florida in red, Florida in red, California in blue, and Louisiana in kind of like a black or very dark purple. Those are some of the largest residual markets in the country, and they've seen a tick upward in their number of policies per year. Although some residual markets are fairly flat or even declining. It's just the largest ones that are growing. Now we'll zoom into citizens first and then look at California to get a better sense of the specifics of some of these large residual markets. This plot is showing the number of residential policies in force over time in Citizens Property Insurance Corporation in Florida. So again, the largest residual market in the country. On the left, that's the axis corresponding to the number of policies in force, and that's the orangey red bars. And then on the right axis, we're looking at market share percentage within the state, and that's corresponding to the line. And we can see that there was a peak in 2011, about 1.4 million policies, making up almost a quarter of the residential policies written in the state. Then after 2011, there was a depopulation initiative and a decline in the number of policies in Citizens. We've seen a tick upward in recent years, but the latest data in 2025 actually show a relative decline compared to this relative peak in 2024. So a constantly evolving situation there in Florida. Now we'll start really diving into the California case. California's Fair Access to Insurance Requirements Plan is experiencing significant stress, and we've seen significant growth in recent years. So we can see between 2015 and 2024, the number of residential policies in force in California's residual market has more than tripled. In percentage terms as well, we're seeing a growth in market share for the FAIR plan. So this is really not what regulators want, but perhaps a function of risk and what the private insurers are willing to tolerate. Overall, state residual markets are generally incentivized, like I mentioned earlier, to try to move their policies from the residual market back into the private market. This is often explicitly enshrined in statute. So we see active efforts on this part to make residual market policies less competitive, less appealing than peer or alternative private insurer policies. And I'll just quickly note here, there's some really interesting work that Professor Pari Sastry et al. Have done looking at Florida's depopulation program in particular, and you can see that there are certain insurers that have relatively higher insolvency risks compared to alternatives in the market. They dominate the Citizens Depopulation Program. So something to keep an eye on going forward. Now, last, before we get into the specific case study of the LA fires, I'll just note that the NFIP, as we mentioned, is this publicly underwritten plan. And despite its availability, and despite many mandatory purchase requirements, as well as growing evidence of growing flood risk, we see fairly anemic uptake in recent years. So this plot is simply showing a decline in the number of written residential policies in the NFIP, as well as a decline in the amount of coverage written. So this is a trend to note, especially in complement with the fact that the private insurance industry or private underwriting for flood is not making up the losses here in terms of number of policies written and coverage written. And then last for this section, a note that insurance markets are generally not designed to price medium and longer term climate risks, for example, sea level rise. So this is a plot from a paper that I have under review that looks at housing units exposure to both current estimates of flood exposure as well as future projections for permanent inundation under sea level rise scenarios. And there's quite a bit of overlap there. Your flood insurance policy, your homeowner's insurance policy, etc., is likely going to be a salient indicator of risk in the near term, but they're not really designed to price in these longer term climate risks. So that's something to keep in mind as you're thinking about these issues. So now in the last couple of minutes of the presentation, we'll just take a look at some of the data from the Eaton and Palisades fires that I mentioned earlier. And of course, these fires were just over 2 months ago. So there are still data coming out in real time from the impacts of these areas, which are only just now beginning to recover. So we leverage quite a few data sources here. We look at Census Bureau data in this slide, as well as Microsoft data, which rely on satellite imagery and some statistical models to identify the number of structures that were damaged by these fires. And what we do is identify the zip codes that have really acute impacts. So I've highlighted one zip code here, 90272 in Pacific Palisades in California, affected by the Palisades fire. That zip code has about 10,000 housing units, and it was estimated that about 6,000 structures in total were impacted by the Palisades fire, damaged by the Palisades fire. So we're going to focus on that zip code, as well as zip code 91001 in Altadena, affected by the Eaton fire. And that zip code is estimated to have about 13,000 housing units and about 8,000 structures that were damaged during the fires. Overall, in this example, the zip codes that were impacted tended to have median incomes that are well above the state and national average, including the 2 zip codes that we'll focus on in Pacific Palisades and Altadena. Median household incomes in those 2 zip codes of about $200,000 and about $134,000 per year. Here we're looking at some of those Federal Insurance Office, Treasury Department data from the zip codes that I just mentioned, compared with nationwide totals. And we can see that in the yellow bars representing Pacific Palisades, homeowners insurance premiums were significantly higher than the national average, whereas the Altadena zip code, the average premium paid was comparable to the nationwide average. So in 2022, the Pacific Palisades average premium was about $6,700, really quite high, and perhaps an indication of risk. Although in Altadena, maybe you're not getting a strong risk signal there through your premium. Now we're looking at non-renewal rates in these acutely fire-affected zip codes. And we can see that really starting in 2019, both the Pacific Palisades zip code and Altadena, 91001, have non-renewal rates that are substantially higher than both the state and nationwide averages. So private insurers were canceling policies at a much higher rate in these areas that were ultimately acutely impacted by the Eaton and Palisades fires. And then when we look at the non-payment cancellation rates, which are shown on this slide, we see that relatively high incomes in Pacific Palisades and Altadena zip codes maybe led to these relatively low cancellations due to non-payment, highlighting that homeowners who can afford high premiums may still face availability challenges. So it was a high income, they were high income areas with relatively high non-renewal rates, and that harkens back to the availability affordability dichotomy that we made in the beginning. Also important to note that there is within zip code income variation that we're not seeing here. And the previous slides then ultimately lead us to this one, which shows both the year-on-year growth in the number of fair plan policies in the zip codes affected by the Eaton and Palisades fires. The yellow bars correspond to Pacific Palisades zip code, the red bar, Altadena. You can see particularly in 90272, the yellow bars, there's higher growth into the fair plan year on year than the statewide average. The two lines we're looking at as well correspond to the number of residential fair plan policies in the zip codes, the two acutely affected zip codes. That's the lower line. And then the total number of annual residential fair plan policies in all fire affected zip codes. So that larger group of zip codes I showed a moment ago. And just in the zip codes 91001 and 90272, we saw between 2021 and 2024, the number of fair plan policies go up from about 1,200 to about 2,400. So almost double in 3 years. Again, highlighting that some of these areas that were impacted had growing fair plan exposure leading up to the fires. And now what is the current state? Well, policyholders statewide are going to be paying more because the fair plan experienced its first substantial threat of insolvency in about 3 decades. So recently, the California Insurance Commissioner issued an order that authorized $1 billion in emergency assessments on all plan members. So all of these private insurers in the state, the admitted insurers primarily, on multiple lines of insurance. So those include dwelling and commercial lines, according to the commissioner's order. There are some exceptions, so you wouldn't see an add-on to your costs in your auto insurance policy next year in California because of this, but perhaps in your homeowner's policy. And that's just so that the current claims that folks are owed via the FAIR plan can ultimately have the costs of those recouped, since the FAIR plan is unable to pay those without the emergency assessment. And that's just one example. Now, a brief federal and state policy outlook before we wrap up. So at the state and local level, there's of course a lot happening. Given all the different state regulators, in the California case, some examples. California recently adopted a regulation that allows insurers to use catastrophe models in their rate calculations. And a stipulation for that is that the insurers will need to commit to writing more policies in high-risk areas. And there's a similar back and forth between the insurance commissioner and State Farm regarding raising their average premiums. And in order to raise premiums, again, we see this negotiation where State Farm would need to put a pause on policy cancellations, among other things. In addition to negotiation between insurers and the regulator, we also see low-income households and, we also see households and their insurers negotiating. And so work by Carlos and his co-authors has found that in some contexts, particularly the study area they look at in Louisiana, low-income households and households of color after past storms have tended to be less satisfied with their claims process. So this is something that regulators will need to keep an eye on in terms of the fair adjudication of claims from policyholders. Then at the federal level, I think it's fairly safe to assume that we're going to see a general pullback in analysis around climate risk in the residential property insurance markets. For example, the Department of Homeland Security chapter in the Project 2025 documents argue for privatization of the NFIP. I would point folks to the Harvard Law School Environmental and Energy Law programs, federal policy tracker on some of these items if they want up-to-date news with a legal analysis grounding. Also, worth noting some recent executive orders to both evaluate FEMA's role in the larger disaster preparedness and response and recovery national apparatus, as well as repeal of, for example, one executive order that I mentioned earlier on climate-related financial risks, which led to the Federal Insurance Office report that we saw. So I don't think we should expect too many more reports and data sets like the ones we've analyzed in the next few years. And then, of course, in Congress, there are various bills being written around this issue, but I wouldn't expect any of these to pass if they were to, for example, introduce a federal reinsurance program, which some folks have posited. There are reasons to be optimistic here. There's innovation in terms of construction approaches. The Insurance Institute for Business and Home Safety has their fortified standard. That's really promising, as well as financial incentives that state and local governments are making available to homeowners for home mitigation. There are nonprofits, Insurance for Good, Insure are two that come to mind, who are trying to leverage insurance tools to achieve certain social and environmental goals. Again, there are innovative financial products, parametric insurance, building code coverage that might make the claims process easier and facilitate climate resilient development post-disaster. And then climate risk disclosure requirements across states, as well as the democratization of climate risk data products, could help folks make better informed housing choices, either about where to migrate to or what remodeling decisions they might want to make in their homes. So these are the same 4 key points. I know we're almost at time. These are the same 4 key points that I mentioned up at the top. To have that historical bookend, as you can see, I wanted to work with Carlos for years, actually. And I think in part that's because of his broad lens and historical take. I'll one-up you, Carlos, and go back to the 18th century with my final slide from Benjamin Franklin, yes, that Benjamin Franklin, who wrote to the Pennsylvania Gazette in 1735 a letter titled On Protections of Towns from Fires. And this is where the adage, an ounce of prevention is worth a pound of cure, I believe was first quoted. And to me, this just resonates because climate change is a new challenge. It's intersecting with long-standing risk management issues. Some of these problems span generations, but some truths, such as the one that we're looking at here, are timeless. So I will thank everyone for their attention. I know it was a lot, and if we have time for questions, we'd love to take them.
Thanks so much, Dr. Koller. And unfortunately, we're at time, but I will ask for people's indulgence if people have to drop off. We completely understand. We had scheduled until 3 p.m. Eastern Daylight Time, but we can stay on an additional 10 to 15 minutes if Steve is okay with that. We're taking a couple of these questions because there have been some great questions coming in, and I'm trying to categorize some of these so we could be as quick as possible. And if I can, with a first grouping. It's around making sure that, and I think this came later in Stephen's presentation, that people understand that climate change's effects are actually increasing exposure, which causes increased insurance premiums. And so if anybody had any questions around that. But there were also a range of questions about what else is contributing to those increasing insurance premiums. And so we know clearly the actuarial risk from climate change's effects in particular scenarios like flooding, like wildfire, is increasing. But if we could talk about some of these other ones, and having your experience in Florida, Steve, and comparing it to the California context that we're seeing now is really helpful because certainly Florida was well known for one additional increased cost, one of these other expenses that you refer to, and that was the rise of insurance litigation in Florida. So I don't know if you want to talk a little bit about that, how that process worked, how that contributed to a lot of the insurance increases there, but may not be happening in other places.
Thanks, Carlos. Yeah, in terms of the specific data, I don't have those at my disposal, but I will say in conversations with folks who are both studying as well as working within the insurance industry, litigation risk comes up time and time again in conversations about these rising costs. So as we noted, climate-related perils and role of climate change, is their replacement costs always a top concern? And then litigation. So if there are folks who are perhaps abusing the legal system to try to get a claim payout that they are not eligible for, that is a concern for insurers, and it cuts both ways. There are cases where folks are trying to abuse the system to try to get a payout they might not be eligible for, and vice versa. There are cases where there are folks who really might have a justifiable uh, claim for a certain payout, and they, for whatever reason, are not able to acquire that. So I think broadly in the US, litigiousness is an issue, and in the insurance sector, it is no exception. But I don't know the numbers in terms of the cost trends for litigation costs off the top of my head.
No, I wouldn't expect you to know those off the top of your head. But certainly this interplay of other factors. I mean, I want to make, and hopefully people got that from Stephen's presentation. Climate change's effects are contributing to rising insurance premiums, regardless, particularly in high risk areas. And that includes the hazard related insurance like flood and things like fire that is covered under traditional homeowners panel. Another way I want to talk about this is that spectrum that you have between the private insurer and the public insurer. And there are a lot of questions that were coming up around, well, it wasn't always a consistent trend. Like in Eaton, we saw a clear rise over the last few years of more people going to the California's FAIR plan. But in Citizens, we've actually seen a depopulation occurring. So if you could talk a little bit about the intentional things that have occurred that the state has done to depopulate the Citizens program and the private markets in those places that have filled in those voids.
Yeah, I mean, great point. In the Citizens context, this is one example where we saw the data, but it's representative writ large of these strong statutorily required incentives or motives to move people out of the residual markets. So there are a number of mechanisms that people use for this, some of which are making making transition back into the private sector more frictionless. So doing a good job of pairing folks who are policyholders who might be on the Citizens program, matching them with an admitted private insurer in the market who has met certain standards. So I think there's really a lot of area for improvement there, and one thing we want to make in terms of reducing friction as much as possible. And what we want to make sure is that folks who are moving back into the private market are working with or getting a policy from a solid insurer.
And certainly, as Florida, we could say was the canary in the coal mine around some of these issues. We may see California following suit and doing that same sort of matching or trying to reduce the exposure to the state coffers around these. There are a lot of really interesting questions I want to take on maybe two groupings of these. And one of them is around consumer responses and options, knowing that a lot of people, if they lost their private insurance, went to the state option. When the state option becomes untenable for them, or they find or completely unaffordable to them, for example, what happens? What are the options that people are taking?
This is a great question, and I wish I had a better anecdote to share because I would love to put a human story behind it. My understanding is generally the FAIR plans are doing whatever they can to ensure that policyholders in their state are able to at least access insurance through the FAIR plan. The quality of the policy you get through the FAIR plan is probably not going to be as good as what you would like. You're probably paying more for less, but the access is there. I can't think of a specific uh, example of someone who might be required by their mortgage lender to have a policy, and then even the insurer of last resort won't insure them. But uh, if there are any reporters on the line, I would love to see some reporting on that topic.
And along in that same grouping, there were questions around, well, people, is there such a thing as an insurance-induced climate retreat or climate displacement, climate mobility? Like people are just abandoning properties because of the insurance risk, right? It's a challenging one because usually where you see those risks go up are places that just have gone through a disaster, right? So there may be other reasons or an acute event, right? But if you want to talk a little bit about that, have we heard any stories around that kind of retreat or displacement entirely because of insurance costs?
Yeah, it's a point I've been thinking a lot more about. And I'll say that there are scholars who have been working on this topic of retreat for years, decades, and specifically thinking through the institutions of public hazard mitigation agencies who might engage in a buyout of a property and viewing that as a form of retreat. And then we also hear retreats talked about in this insurance context, like you're mentioning, Carlos, where it's an insurer that may abruptly decide to retreat from a given market, and that has implications for a specific policy. So I think there's really a lot of room for coordination and discussion and data sharing, thinking long term about what are some areas that not just next year are going to see a price increase, but in 10 years, in 20 years, can we take some of the analytical firepower that the insurance sector has and have them apply it towards some of these bigger temporal scale questions that a lot of folks have been studying
Long-term
for
regional
years.
planning interconnection. That's
Exactly,
right.
exactly.
And one of the questions that was in this category was around other countries and how if they have had clearly every country on the planet is suffering through some kind of climate change effect. In some cases, that leads to acute hazards. So if there are other insurance scenarios that have been playing out in the same way that have led people to have affordability crises, uh, leading to choices of abandoning properties and that sort of thing. And I think I want to give Stephen out in this one only because his focus has entirely been on the U.S. Insurance framework, which is a very unique one in the developing context. Most other developed countries, excuse me, have all peril nationally regulated insurance structures, right? This is true in places that are suffering through some of the same things that we saw in California with the wildfires, Spain, Portugal. They're nationwide regulatory structures that require a spreading out across all perils and a lot of reinsurance opportunities. So I don't know if you want to add to that, Steve, but there was some interesting questions about how we compare and how we've set up our system separately.
Yeah, I two thoughts come to mind, and I appreciate your giving me the out and giving that grace. First is that actually compared to a lot of countries, especially in the global south, the US, when we're thinking about this protection gap, that term I mentioned earlier, we're actually a relatively highly insured small protection gap country. And so our insurance sector is quite advanced. These products are fairly widely available. And as we see, they do a lot of good, especially in the housing finance system to give people access to housing and recovery funds post-disaster. Many other countries aren't aren't benefiting from the the sector's work. That's the first one. The second one, on these international comparisons, I do know in general that there are very different configurations abroad. In some cases where hazard insurance is not as voluntary as it is here, there may be more bundling going on, and it's really a bit more like a taxation system in the sense that there's less of a voluntary component. And I would point folks who are interested in this more towards the great book Understanding Disaster Insurance by Dr. Carolyn Kuski. That is where I've learned quite a bit on these topics, and there are great international examples in there too.
It's a good plug. I actually have it right in front of me too. The last pool of questions that I want to talk about are around the policy questions that you come up with at the end. You noted sort of the potential for what may be occurring with a FEMA elimination, which includes NFIP privatization, as has been projected. How about on the activity around mitigation strategies, mitigation funding, and building codes? I mean, certainly in the building codes world has also been struck by the change in administration. The federal flood risk management standard, of course, was rescinded by Donald Trump twice after it was started by Obama and then rescinded in Trump one, brought back by Biden, rescinded in just this past January by Donald Trump. But there are also other standards, other opportunities to think about rebuilding in places like Palisades and Altadena, California. If you could talk a little bit more about some of that pool of the positive ending, and it's a nice way to end our conversation too.
Yeah, and I think it's a nice place to end because this is so important. As I know you've noted in your work, these moments following a disaster are critical rebuilding periods where we have the opportunity to build a housing stock that we want. But at the same time, people are dealing with uh, a decrease in housing supply. They're looking for a place to live, and it's not as if affordability constraints have evaporated despite the outpouring of support. So there, I think, are some promising examples where we're doing a good job of making sure that the right funding and the right building standards are flowing post-disaster. One example that I like is building codes coverage. This is a type of insurance policy where if you have it and there's a specific loss, you're actually able to build back to the new building standard, even if you were not built to code before the disaster. And you pay a little bit more for that policy, but it allows you to truly build back better. I know that that's kind of a cliche term, but that's one example. And I cited the Alabama example earlier, but I think states could do more to incentivize through these grants or loan programs the adoption of these to code or above code building examples, because that could save in the long run, as Dr. Franklin said, an ounce of prevention is worth a pound of cure, and I think the same goes for building.
Was Benjamin Franklin a doctor? That's a good question.
He, I
Wiser than
Some
us.
people call him doctor. Yeah, I'll call him doctor, but someone else
All
will
right.
have to fact check me
Well,
on that.
it's a good way to end our conversation today to quote wise people who preceded us before in the United States, and I hope will be guiding us in the future. This is clearly an ongoing subject. The Joint Center is committed to tracking all kinds of cost burdens that occur to homeowners and renters, and this is one of the growing ones. So thanks for contributing to our conversation about this, Dr. Koller, and thank you all for joining us. There were so many questions. I'm sorry I can't keep track of all of them that we weren't able to address them, but thank you for joining us and stay tuned for future events in the same vein. Bye, all.
Thanks, everyone.